Okay, welcome back to video number 2, where we're still looking at our current liabilities and payroll, but I want to make the distinction. We talked in the last video, we finished up by talking about current liabilities versus long-term. So current liabilities and long-term liabilities, and how do we distinguish between current and long-term? Current liabilities are liabilities which are due. It means we have to make a payment or provide service. Due within 1 year or the operating cycle, whichever is longer. So they're obligations that are due. You're going to make payment or provide a service within 1 year or the operating cycle, whichever is longer. So a place like Harley-Davidson, they manufacture what? Motorcycles, high-end motorcycles, right? The operating cycle for Harley-Davidson is a lot longer than 1 year. So if you were to ask them or work for them and try to classify current and long-term liabilities, they would have a longer than 1 year operating cycle. So we would use whatever is longer. Most companies you're going to run into are going to deal with an operating cycle of less than a year. So the 1 year will be the mark. Long-term liabilities are what? Liabilities that are due after 1 year. So I will say, I'm going to just put after 1 year or the operating cycle, whichever is longer. So it's really the distinction between within 1 year or after 1 year. Makes sense. Current, long-term. So let's look at some examples of these. And here I want to make up a little chart where I kind of put a name here, and then I'll check off current and long-term, because some liabilities can be both current and long-term, and that'll make sense when we get some examples. But let's take the example of accounts payable. Accounts payable. We were introduced to accounts payable early on. Chapter 5, we looked at accounts payable as a merchandising concern, buys inventory. So we buy sneakers and we turn around and sell sneakers. When we buy those sneakers, usually we're buying them on account. And the entry to buy the sneakers is we debit what? Either the inventory or purchases, depending on what kind of inventory system we're using, right? Stretching you backwards into inventory and merchandising accounting. And we're crediting accounts payable. So accounts payable are a current liability. You're not going to see accounts payable as a long-term liability. They're also called trade payables. They are the most currently due payables that you'll have will be your accounts payable. So let's think of some examples other than that. How about, I'm going to put short-term notes payable. Actually, you know what? Let's get rid of short-term. Let's just put notes payable. Why? Because notes payable can be both current as well as long-term. Notes payable is a formal obligation to make payment. Accounts payable is not a formal obligation in the sense that there is any kind of a promissory note which is exchanged. When you're dealing with notes payable, you're dealing with something that's more formalized. There's a document that you're signing. It can be both a current liability and a long-term liability. If we sign a 3-year note to make a payment to somebody, we would take the first year of that note and show it as a current liability, the last 2 years and show those as long-term liabilities. How about wages? Wages payable. Current liability. We come between two accounting periods. We have wages which are due. We need to accrue the expense and record the liability. That is always going to show as a current liability, not a long-term liability. How about warranty? Warranties, that can be both current liability and long-term. You buy a car, it's a 3-year, 36,000-mile warranty. The first year of that warranty will be reflected as a current liability. The last 2 years will be reflected as long-term liabilities. It's pretty straightforward. Leases. Leases can be the same way. The current portion of a lease and a long-term portion of a lease. We lease a building for 10 years, let's say, or 5 years. First year will show as a current liability, or the current year will show as a current liability, and the remaining years will show as long-term liabilities. Taxes payable, like a corporation, taxes payable. that will be a current liability. For the most part, that'll be something that's paid within the next year. And then the last one I'm going to show is just unearned income. Unearned income. Remember where unearned income comes from. A good way to think of this is ticket sales, sporting event, concert, some kind of a musical event. They receive money in advance. And when they receive that money in advance, they're recording it. Let's make the entry. They're going to debit cash. Okay? And they're going to credit unearned income. Unearned income. Or deferred revenue. Deferred revenue means postponed. We're deferring the revenue. We're postponing the receipt of the revenue. What are we trying to do? We're trying to stay and record transactions in accordance with generally accepted accounting principles, specifically the matching principle. Here's our timeline. And we want to match time period 1, time period 2. We want to match revenues and expenses in the same time period. Match revenues with expenses in the same time period. So if over here in time period 1 we receive a lot of money for things that are going to be performed over a multi-period time period, this is the current portion, this is the long term. So our unearned revenue can be what? Both current and long term. And we just have to calculate and estimate. If we know, let's say it's advanced ticket sales for concerts that we're going to be performing over the next 2 years, and our operating cycle is 1 year, we actually know we have events scheduled in advance, and be very specific about what we consider to be current unearned income and long-term unearned income. So I just want to show different liabilities here, show them as current versus long-term portions. And what we're going to do in the next video is we're going to be specific and look at payroll. Payroll can be very confusing. How do we account for payroll? We have two things with payroll. We have the actual wages that we're paying somebody. Let's say I hire you to work for me, and I'm paying you $3,000 a month. Well, during that month, I have to record the expense, the wages to hire you, which is $3,000. But I also have to record the taxes. If I'm an employer and you're an employee, it doesn't just cost me $3,000 to have you work for me for a month. It's the $3,000 is the wages, and then on top of that, there are the taxes, the payroll taxes, which are also an expense for me. But we'll look at that in the next video because it's current liabilities and accounting for current liabilities as specifically applied to the handling of payroll. So, we'll see you in the next video.